Imagine a company that just increased its revenue by 150%,
Uh,
like in a single quarter.
Right, which is just wild.
Yeah, exactly. They're pulling in $42 million dollars, and they're boasting this staggering 26% net profit margin. I mean, on paper, they look like an absolute powerhouse
Right.
producing this highly sought after commodity at just world-class
Oh,
margins.
absolutely. The numbers look incredible at first glance.
But at the exact same time, this very company is forced to tell the SEC that it might not, have enough cash to actually keep the lights on next month. You are looking at Sigma Lithium.
It's honestly one of the most compelling contradictions in the market right now,
It really is.
because you rarely see a business operating at the absolute top of its tier in terms of, physical production, while simultaneously sitting on the razor's edge of insolvency.
Yeah, the fundamentals of what they pull out of the ground are stellar, but the financial architecture supporting it is, well, it's trembling.
That's a great way to put it.
So, welcome to this deep dive into the high stakes, incredibly volatile world of lithium mining. Our mission today is to unpack this classic investment paradox using Sigma Lithium Corporation, ticker symbol SGML, as our case study.
And this is something you really want to pay attention to, whether you're tracking the electric vehicle supply chain, looking closely at commodity markets, or even if you're just, fascinated by extreme business turnarounds.
Exactly. We're going to dissect the ultimate financial tightrope walk. We're synthesizing their trailing 12-month data, recent quarterly explosions, SEC filings, and some technical charting to get the full picture for you today.
Yeah, we've got a lot to cover.
So let's dive right into the core mystery here, which is this massive disconnect between their past year and their most recent quarter.
Well, the best place to start is really the rearview mirror. If you look at Sigma's trailing 12 months, like the TPM data, the picture is pretty grim, to be honest.
Graham is putting it lightly, right?
Yeah, I mean, revenue declined almost 50%, 49.19% year over year, and net margins were deeply negative, sitting at this brutal minus 41.82%.
Which paints a picture of a company in a complete free fall.
Yeah.
But we have to ask why. Like, why was it bleeding out so heavily over that specific 12-month period?
So two main forces basically collided. First, you had the macro environment. Global lithium prices went through this severe suppression phase because, well, EV demand forecasts were dialed back, right?
Yeah, supply chains were rebalancing and all that.
Exactly. And when your underlying commodity price craters, your margins just vanish overnight. Second, Sigma was going through extensive internal operational restructuring.
So they were spending heavily while making less.
Right, they were spending money to reorganize their production processes at the exact moment their product was losing value on the open market.
Talk about bad timing. But then we snap our focus to the first quarter of 2026, and the narrative just flips entirely.
It's a total 180.
We see this massive inflection point. As I mentioned earlier, revenue hit $42 million. And the profitability metrics are what really jump off the page for me.
Oh, for sure. The margins are crazy.
Right. They hit a 61% gross margin, a 39% EBIT margin, and that 26% net margin. And I want to pause on EBITDA for a second.
Yeah, it's an important one to break down.
Because for those who aren't, living in financial spreadsheets all day, that's earnings before interest, taxes, depreciation, and amortization. Basically, it's a measure of the raw cash the core business is throwing off before the accountants and the debt collectors get involved.
Right, it's the pure operational horsepower.
Exactly. And generating a 39% EBITDA margin in heavy industrial mining is incredibly difficult.
It really is. It requires flawless operational execution, converging with basically favorable market pricing. In Q1, the macro winds just shifted back in their favor.
They caught a break with the pricing.
Yeah, big time. Their realized price for high-grade lithium oxide hit $1,790 per ton.
Let's actually define what they are selling, because the sources mentioned they produce SC5. What does that actually mean for you, the listener, tracking the EV supply chain?
So SE5 refers to spodumene concentrate with a 5% lithium oxide content.
Okay.
Spodumene is the actual mineral they mine out of the ground. And after they crush it and process the raw rock, they are left with this concentrate.
Got it. So it's not the finished battery stuff yet.
Exactly. A 5 or 6% purity level is pretty much the industry baseline. It's the raw material that chemical converters and battery makers buy to refine further into, battery-grade lithium carbonate or hydroxide.
Okay, so getting almost $1,800 per ton for SC5 is a very strong realization price.
Oh, it's fantastic. To put that in perspective, just a couple of quarters prior, like in Q3 2025, they were getting only $630 per ton for that exact same product.
Wow. That is a massive swing. And the momentum seems to be holding, right? Because the Q2 2026 production data just came out, and they beat their own guidance.
Yeah, they ended up producing 35,000 tons of concentrate.
So instead of a generic turnaround story, the mechanism here feels more like what we're trying to restart a massive factory engine while the building is already being towed down the highway.
That's a great analogy.
Like for 3 laps, the engine was sputtering, parts were falling off, and the market just assumed the factory was dead. Then suddenly all the gears lock into place, the engine roars to life, and it's pumping out premium product at record speeds.
Right.
But the question is this a permanent fix, or did they just hit a lucky patch of smooth road with that price bounce?
Well, answering that requires looking past just the revenue. We have to examine the physical reality of how they actually mine.
Right, the operations themselves.
Exactly. We need to understand their competitive moat and the underlying math of their operations. Sigma positions itself as this Tier 1 low-cost producer operating out of the Minas Gerais region in Brazil.
They also market themselves heavily as using a quote-unquote green tech processing approach.
Yes, they do.
But in a traditionally dirty industry like mining, what does that actually mean mechanically? And I guess more importantly, why does it matter to their bottom line?
Mechanically, a green tech approach typically involves eliminating hazardous chemical tailings, which is a big deal. They use 100% renewable energy for the processing plant, and they rely heavily on water recycling.
Okay, that sounds expensive upfront.
It can be, but they also use dry stacking of waste rock rather than building massive toxic tailing dams.
Got it.
And it matters to the bottom line because Western automakers are hyper-focused on the carbon footprint of their entire supply chain right now.
Oh, right, because of all the ESG mandates and optics.
Exactly. If Sigma can provide lithium that is certifiably greener than a competitor, they secure priority contracts, and they can sometimes even command a premium price.
That makes a ton of sense.
But the most crucial metric for their long-term survival isn't actually just the green label. It is their AISC.
The all-in sustaining cost. This is a metric we see constantly in mining analysis. It's essentially the truth serum for a mining company, wouldn't you say?
Oh, absolutely. It strips away all the accounting magic and shows the actual cost of keeping the lights on.
It prevents management from hiding their true operational expenses in the fine print.
Right. AISC factors in the cost of digging the rock out, processing it, paying local royalties, administrative costs, basically everything.
Plus the sustaining capital required to just maintain the current level of production, right?
Yes, exactly. It is the true break-even point. And Sigma's AISC is highly competitive on a global scale. Right now, for phase 1 of their operations, it sits at $710 per ton.
Okay, and as they scale up and finish constructing phase 2 and 3, they expect that cost to drop even further, right?
Yeah, they're projecting it'll drop down to $610 per ton due to economies of scale.
Now, this is where the math gets really fascinating, but also, frankly, suspicious.
Yeah, let's do the math.
Let's do the cash flow calculation. If your all-in cost is $710 a ton, and you are selling it for almost $1,800 a ton in Q1, I mean, the profit spread is massive.
It's a cash machine.
Even if we use a highly conservative future lithium price of, say, $1,500 a ton, the sources indicate that phase 1 alone yields about $130 million in annualized cash flow.
And the long-term ambitions are what make those numbers really jump off the page.
Right, because phase 1 is just the start.
Exactly. Phase 1 gives them a capacity of 270,000 tons a year, but their master plan targets the completion of phases 2 and 3 by year-end 2027.
Which would bring their total capacity to what?
A staggering 770,000 tons.
Yeah.
If they maintain that low-cost structure while nearly tripling production, the cash generation at scale just becomes phenomenal.
I mean, at a $1,500 per ton sale price, running all 3 phases would generate roughly $493 million in cash flow.
Almost $500 million.
But I have to push back here. Because as a conservative analyst, my alarm bells are ringing aggressively.
I don't blame you.
If they are clearing $1,000 in pure operating profit on every single ton they ship out of Brazil,
Yeah.
their bank account should be overflowing. They should be bulletproof right now.
You would think so, yeah?
So why is there any anxiety in the market about them hitting that 2027 capacity target? A company generating a 26% net margin shouldn't be stressing out its investors. Where's the cash actually going?
Well, the cash is being devoured by their balance sheet and the massive capital requirements of scaling a mining operation.
Ah, the expansion costs.
Right. Building phase 2 and 3 isn't just a matter of flipping a switch. It requires hundreds of millions of dollars in upfront capital expenditures.
Like ordering heavy earth-moving equipment, constructing new processing plants.
Exactly. Hiring hundreds of workers, all before a single new rock is processed. The brilliant operational math you just described is currently colliding with a harsh liquidity crisis.
So we have to look at the empty bank account.
We do.
This is where the story pivots from a victory lap into a full-on survival thriller. Let's dig into their SEC filings. As of March 31st, 2026, Sigma reported a negative working capital of roughly $144,000.
Which is a huge red flag.
Let's break down that term for you because it is the linchpin of the bearish argument here. Negative working capital basically means that their short-term liabilities, the bills due within the next 12 months, exceed their current liquid assets.
The number itself is bad, but the language they were legally forced to use in their management's discussion and analysis is what really sent a shockwave through the market.
What did they say?
They explicitly stated that this negative working capital, and I'm quoting directly here, may cast significant doubt on the company's ability to continue as a going concern.
Oh man, going concern is arguably the most terrifying phrase you can find buried in a corporate financial filing.
It absolutely is. In accounting standards, a going concern assumes a company will remain in business for the foreseeable future.
Right.
When management and their auditors formally state there is significant doubt about that assumption, they are waving a massive red flag to regulators and investors.
They are legally admitting that without an immediate change in circumstances or a new infusion of cash, they might literally run out of money to operate the business over the next year.
Exactly.
Let me try to translate this corporate accounting situation into an everyday scenario for you listening. Imagine you just landed a massive promotion. You're earning a high six-figure salary.
Right, living the dream.
Yeah. On paper, your monthly cash flow is incredible. Your margins as a human being are stellar. But you log into your banking app and your checking account has $0 in it, your credit cards are completely maxed out, and a massive mortgage payment is scheduled to auto-deduct tomorrow morning.
That's rough.
You are wealthy on paper, but functionally, in this exact moment, you are completely broke.
That analogy perfectly isolates the problem here. Operating cash flow does not equal liquidity if the debt burden is just too high.
Exactly.
If we look at Sigma's actual cash on hand at the end of Q1 2026, they had just $4 million in the bank.
$4 million. That's nothing in mining terms.
Nothing. And they were sitting against $134 million in debt. You cannot fund the construction of a massive phase 2 and 3 mining expansion with $4 million in the bank.
Now, management did push back in the filings, to be fair. They stated they are, quote, comfortable with their ability to continue operating, pointing to their recent Q1 operational success.
Right, they had to say something.
And they did manage to secure a critical lifeline to avoid hitting zero. By mid-April, their cash position had improved to $28 million.
Which was driven by strong sales receipts and, crucially, advanced payments from a $96 million working capital facility.
Let's explain what that facility actually does, because it sounds like jargon.
Yeah, a working capital facility is essentially a short-term corporate line of credit.
Okay.
In heavy industry, there's this massive time gap between when you incur the cost of mining the product and when the final customer actually pays the invoice.
So they need a bridge.
Exactly. This facility acts as a bridge loan, allowing Sigma to pay their daily bills, meet payroll, and keep the machines running while they wait for their revenue to clear the banking system. It buys them breathing room.
But breathing room is not the same as a permanent solution. I mean, having $28 million in cash against $134 million in debt while actively trying to fund a massive expansion, it leaves them with absolutely zero margin for error.
Not at all.
Which leads us to look at how the broader market is reacting to this risk. Let's analyze the technicals and the regulatory environment. or what I like to call the Brazilian standoff.
Well, the market reaction is heavily driven by psychology and risk aversion. You have this incredible operational growth potential chained to a terrifying liquidity constraint.
And then, as if that weren't enough pressure, you layer on jurisdictional and regulatory friction.
Right. It never rains, but it pours.
Seriously. Sigma is currently facing an environmental notification from a regional Brazilian environmental body, and they are actively having to negotiate a settlement with the Minas Gerais state government.
Now, the sources don't give us the granular details of the specific environmental infraction, but in the mining sector, an environmental notification is never a minor issue.
Never.
It introduces the threat of halted permits, delayed expansions, or massive fines. Markets despise uncertainty, and jurisdictional uncertainty in a South American mining operation is a classic trigger for institutional capital to just flee.
And you see that fear directly reflected in the price action. The stock, SGML, recently traded at $11.38.
Ouch.
Yeah, that represents a brutal 65.8% drawdown from its May 2026 52-week high of $33.28.
The valuation just collapsed from that peak as the liquidity concerns overshadowed the production beats.
I want you to view this through a trader's lens for a second. When we look at the trading volume, it tells a really fascinating story of exhaustion and hesitation.
It's basically a ghost town.
Yeah. The 10-day average volume is incredibly thin, sitting at only about 28,700 shares traded daily.
That's nothing.
Now, there was a recent 5-day bounce where the stock popped about 16%. But when a stock jumps on volume that low, it usually signals a potential unconfirmed speculative squeeze.
Right, it means retail day traders might be covering short positions rather than large funds actually buying in for the long haul.
Exactly. Volume is the footprint of institutional money. When volume is under 30,000 shares a day for a company generating this kind of revenue, it tells you that the massive mutual funds and institutional investors are sitting firmly on their hands.
They see the 61% gross margins, sure, but they also see the going concern warning.
They aren't stupid.
Their stance is cautious. They are waiting for proof that Sigma can survive the next 2 quarters before they commit millions of dollars of real capital.
And you can see that hesitation mirrored in the net sentiment across financial media. It is decisively bearish right now.
Yeah, outlets like Seeking Alpha are issuing strict hold ratings.
Notice they aren't issuing sell ratings, though, because they know the lithium is physically in the ground and the processing actually works.
Right, the product is real, but they are explicit about the headwinds. The consensus is that the Phase 2 execution risks and the severe liquidity constraints simply outweigh the growth potential right now.
The company currently lacks the financial breathing room to guarantee they can execute their own master plan.
So we have a company with world-class operating margins, terrifying liquidity, and institutional money waiting safely on the sidelines.
Which brings us to the critical question for anyone analyzing this space. What does the narrow path to recovery actually look like?
We need a roadmap.
Right. What specific sequence of events needs to happen to save the balance sheet, remove that SEC warning, and actually reward the investors who are brave enough to hold the stock today?
Well, let's lay out the catalyst. We know the destination, but what are the exact steps?
Exactly. What's step 1?
The most immediate catalyst is the full Q2 2026 financial report. We already established that they beat their physical production guidance of 35,000 tons, which is great.
But moving dirt does not equal generating profit.
Exactly. The critical missing piece is the margins. The market needs to see if those Q1 metrics, specifically that 20+% net margin and the positive cash generation, actually held up throughout the second quarter.
If they prove that Q1 was not a one-off fluke, that is the most vital step toward rapidly deleveraging their balance sheets.
Right. Okay, so step 1 is proving the financial engine can run consistently.
What is the next major hurdle?
Step 2 is achieving a formal settlement of that environmental dispute in Minas Gerais. A favorable binding resolution removes a massive binary regulatory overhang.
It signals to investors that the local government is supportive of the Phase 2 and 3 expansions, rather than acting as a roadblock.
Yeah, that relationship is key. And step 3 has to address the debt. They have $134 million looming over them.
So they need a comprehensive capital restructuring.
They absolutely do. They must secure a long-term debt refinancing or find strategic investments.
Like maybe from an automotive partner.
Yes, exactly. Like an offtake partner who wants guaranteed access to their green lithium. They need an injection of capital to fund the expansion phases without diluting current shareholders.
Let's clarify dilution for a second because it's the silent killer of equity investments.
Oh, it really is.
If Sigma cannot secure a loan and is forced to raise capital by issuing millions of new shares right now, with the stock beaten down to $11, it would be incredibly punishing.
The existing investors would see their ownership slice of the company drastically shrink overnight.
Nobody wants that.
And finally, you have the ultimate macro factor, global lithium prices. They need a sustained recovery, or at least a firm stabilization, in commodity pricing.
Because if lithium dips back below $1,500 a ton, that beautiful cash flow math we calculated earlier starts to evaporate rapidly.
Taking all these variables together, the overall assessment from our sources is a cautious neutral, basically a rating of 4 out of 10.
Meaning the operational turnaround on the ground in Brazil is very real, but the financial fragility is simply too severe to ignore.
I think that's completely fair.
I'll act as the voice of the conservative investor here. It sounds to me like this is an entirely binary outcome with zero middle ground.
Pretty much.
If they stumble even once on phase 2 construction, or if the local government delays a permit, or if lithium prices take a sudden dip back to 2023 levels, this whole house of cards collapses under the weight of its own debt, right?
That is the sober, unvarnished reality. The path to recovery is credible, but it is incredibly narrow.
They have to execute flawlessly.
On complex mining operations, yes. Plus, the global commodity markets have to cooperate, and they have to successfully navigate a Brazilian regulatory dispute.
A single misstep in any of those 3 arenas could force an emergency capital raise at highly depressed prices, effectively wiping out current equity value.
Which brings us to the core lesson of this entire deep dive. We started by looking at the incredible tension at the heart of Sigma Lithium.
You have this Tier 1 asset, world-class processing margins, and this ambitious, highly lucrative plan to triple capacity by 2027.
But it is entirely handcuffed by a terrifyingly thin liquidity cushion, heavy debt, and environmental disputes.
It serves as a textbook reminder for anyone analyzing the resource sector. A great physical operation does not automatically equal a safe financial investment.
Never. You can own the best asset in the world, producing a critical mineral at highly competitive costs, but if the corporate balance sheet is broken, the equity is at immense risk.
Fundamentals are not just about how efficiently you can dig rock out of the ground. They are about how management handles the cash they get for it.
Spot on.
I want to leave you with a broader macro question to mull over, because analyzing Sigma isn't just about understanding one isolated mining company in Brazil,
No, it gives us a window into the entire global green energy ecosystem.
Exactly. Think about the implications here. If the Tier 1, low-cost, highly profitable lithium producer, a company pulling the most critical battery metal out of the ground at incredible margins, is struggling to secure enough working capital to avoid SEC going concern warnings, what does that indicate about the underlying fragility of the entire EV transition?
It suggests a massive systemic disconnect between political climate goals and the harsh mathematical realities of mining finance.
If the absolute best operators in the space are cash-starved and fighting for basic liquidity, how can the global supply chain possibly scale up fast enough to meet the aggressive battery targets set for 2030?
It's a sobering thought.
We all want these electric vehicles on the road, but the companies supplying the essential raw ingredients are walking a financial tightrope without a net. Keep your eyes closely on those Q2 financial releases, because they might just tell us if Sigma makes it to the other side of the platform, or if gravity finally takes over. Catch you on the next deep dive.